Hi everybody. In this series of video exercises, we will explore the accounting for bonds payable and the accounting for bond interest payments using the effective interest method. Please do two things before completing this exercise. 1. Thoroughly read Part A in Chapter 14 of your textbook and work through some of the exercises presented in the chapter. You will need a thorough understanding of the chapter, as this video will present only some of the chapter highlights. Number 2, please download the Excel file embedded in the Exam Number 2 Study Tips and Instructor Study Guide page so that you can complete the worksheets as you watch the video. This video will discuss the accounting for issuing bonds at par. Note that par value, maturity value, and face value all mean pretty much the same thing when we're talking about bonds. As always, you will get the most value from these study guide exercises if you will take the time to pause the video and prepare the calculations and journal entries. Then start the video again and check your answer. If you got it right, you'll feel great. If you didn't get it right, that's okay. There will be a detailed analysis of the correct answer that should give you an opportunity to understand your error. Let's work an example. Issued a bond with a $100,000 par value and 8% annual contract rate. Interest is paid semi-annually, and the bond has a 2-year life. The bond was issued at par. Calculate the amount of cash to be received upon issuance. A bond will be issued at par when the stated or contract rate of interest is equal to the market or effective rate of interest when the bonds are issued. If a bond is issued at par, the cash received from issuing the bond is equal to the par value of the bond. Prepare the journal entry to record the bond issuance. Well, we received $100,000 cash, and we assumed a liability of $100,000 to be paid at the end of 2 years. So debit cash $100,000, credit bonds payable $100,000. Let's calculate the first semi-annual interest payment. Now let me give you a rule. The interest payment is the par value of the bond times the annual contract rate divided by 2 if it's a semi-annual interest. So the annual interest rate is 8%, 1/2 of that is 4%. The par value of the bond, or the face value of the bond, is $100,000. So 100,000 times 4% equals $4,000 interest payment. That's the amount of the check that has to be paid for the first interest payment. Debit interest expense. Some people debit bond interest expense. This book just simply debits interest expense. And credit cash for $4,000. Well, that's all for this video. It was a short one. When we come back, we'll do some more bond practice, and we will work with a bond that is issued at a discount. It'll be a little bit longer video. See you next time.